Welcome to the Deep Dive. We're here to unpack the latest corporate releases, financials, press releases, earnings calls, and really get to the heart of what's going on. Today, our mission is to dive into Firstsource Solutions Limited, FSL. We're looking at their Q2 and half-year results ending September 30th, 2025. But this isn't just about the numbers on the page. We want to extract the key strategic insights, understand this un-BPO strategy they're pushing, the big AI investments, and, well, the momentum that got them past that billion-dollar mark in trailing 12 months revenue. It's a pretty big milestone.
Yeah, this quarter definitely signals a deliberate transformation.
Heck yeah.
Feels like FSL is trying to shake up the very industry they operate in.
Absolutely. When you pull together all the source materials, the story isn't just growth, it's strategic differentiation. Hitting that billion-dollar TTM revenue is significant, sure. But the real takeaway, I think, is how they did it. This is the sixth straight quarter of double-digit year-on-year growth. And crucially, it's profitable growth.
Profitable growth, right?
Yeah, supported by 4 consecutive quarters where they actually expanded margins sequentially.
Yep.
That suggests the market's buying into this strategic bet on AI. It seems to be working.
Okay, let's ground this a bit. Let's unpack the headline numbers for Q2 FY26. Revenue growth looked strong.
It was 20.1% year-on-year in rupee terms, 13.8% if you look at constant currency. That consistency, that double-digit streak, really stands out, especially given how challenging the global IT services market can be.
And you mentioned margins. That's always the tightrope walk, isn't it? How did they do there?
They did well. EBIT margin came in at 11.5% for the quarter. But the key thing, like I said, is the trend. They nudged it up 20 basis points from Q1 and 70 basis points compared to last year.
Okay, 70 basis points year on year.
Right. And what makes that impressive is that the source material points out they absorbed their annual wage hike during this period, covered over 90% of employees.
So expanding margins while dealing with wage increases.
Exactly. That points directly to efficiency gains somewhere else, which, well, that's the promise of this whole un-BPO strategy, isn't it? Finding those tech-driven efficiencies.
Yeah, that definitely tells a story, managing inflation like that. Profit after tax was also up significantly.
Yep, nearly 30% year-on-year. That brought diluted EPS to 2.54.
Okay. And zooming out to the first half.
H1 revenue was up almost 22% year-on-year. That's what officially pushed them over the billion-dollar TTM line. And another sign of really solid financial health is the cash conversion.
How did that look?
Free cash flow to PAT was incredibly strong, 155% for the half year. And the balance sheet improved too. Net debt dropped quite a bit from $13.2 billion back in March down to $10.8 billion by September end.
Good progress on the debt. Okay, now let's dive into that core strategy. Un-BPO. They're talking about replacing labor arbitrage with technology arbitrage. That sounds like a fundamental shift. What are they actually selling now?
Well, it's not just about selling cheaper labor anymore. They're selling a step change improvement in outcomes. See, traditional BPO was all about executing a manual process efficiently, often cheaper. Old RPA just automated that same manual process.
Maybe stick on a pig sometimes?
Kind of, yeah. Technology arbitrage, under this un-BPO idea, is about fundamentally redesigning the whole operation, using their own data insights, and crucially, generative AI. It's moving from, throwing bodies at a problem to using skilled people directing AI to solve the problem.
So selling a solution, not just resources.
Exactly. Selling an outcome enabled by tech.
Okay, but look, every BPO player, every IT services firm is talking about AI right now. It's the buzzword. What makes FSL's pivot more than just, well, marketing spin? Where's the concrete investment?
That's the million-dollar question, isn't it? Or maybe the billion-dollar one now. Their answer seems to lie in 2 very specific strategic investments they made this quarter. They didn't just license generic tools.
They bought capability.
Sort of, yeah. They announced investments in Lizard.ai and a strategic minority stake in another company called Applied AI. They're building or integrating proprietary tech.
Okay, let's break this down. Lizard.ai first.
Right. Lizard.ai is described as a cutting-edge enterprise AI agent infrastructure platform. Think of it as the execution layer. It lets them build secure, reliable AI agents that can talk to each other.
Agents doing specific tasks.
Precisely. And the key selling point, especially for clients in banking or healthcare, is that these agents operate with 100% data privacy. They run inside the customer's own environment, not out in the cloud somewhere generic.
Okay, secure execution. And Applied AI, what's its role?
Applied AI sounds like the strategic brain. It uses a proprietary large work model. Its job is to learn complex workflows across different departments like finance or HR or mortgage processing.
So it finds the bottlenecks.
Exactly. It identifies the friction points, the inefficiencies, and then uses data intelligence to figure out how to re-engineer the entire process from the ground up.
Okay, so if I'm understanding this, let's use an analogy. Applied AI is like the architect who sees the whole building, finds the design flaws, and draws up a completely new, smarter blueprint.
Yeah, good analogy.
And Lizard.ai provides the specialized construction robots, the agents that actually build the new design, automatically and securely.
That's a great way to put it. And they gave a practical example in the earnings call looking at mortgage processing, which, notoriously complex and slow.
Right.
So applied AI comes in and helps rethink the whole flow. It figures out how to triage applications dynamically, maybe route low-risk ones straight to auto-approval.
Okay.
Then Lizard.ai provides the specific agents needed to execute that new flow. You might have a document verification agent, a credit analysis agent, a compliance check agent. They work together autonomously based on the applied AI plan, cutting down human handling dramatically.
Transforming it from a linear manual slog into something more adaptive and self-learning.
And that seems to be the goal, yeah, self-learning adaptive system.
Okay, this strategic stuff sounds impressive, but it has to show up in sales, right? Is it translating into actual market traction?
It really seems to be. The momentum metrics are pretty telling. For the first time ever, their deal pipeline crossed US $1 billion in annual contract value, ACV.
$1 billion pipeline, that's significant.
It is. He shows large clients are seriously considering this tech-first approach. And they backed it up with deal wins, 4 more large deals signed in Q2. That's deals with over $5 million ACV each. They've kept up a multi-quarter streak of landing these big ones.
And expanding the client base, too, adding new logos.
Yep, 10 new logos added in the quarter. And they highlighted that 4 of those are strategic logos, meaning they have the potential to grow into $5 million plus accounts down the line.
And what about relying less on just a few huge clients? Diversification.
That's another strong point in the data. The one Firstsource strategy seems to be working. Revenue share from their top 5 clients actually declined by over 6% in the last 2 years.
So smaller clients are growing faster.
Or rather, their mid-tier clients are scaling up. The number of clients paying them $5 million or more annually jumped significantly. It went from 26 clients in Q2 last year to 39 clients this quarter. That's a big increase in mature, large relationships.
That's a substantial jump. Did they give examples of the kind of large deals they won recently?
They did. In the UK, they landed their biggest ever collections deal, expanding work with a long-term retail banking client. In healthcare, a top 10 U.S. payer picked them for claims data capture, specifically using FSL's own platform, Simpraxis.
So using their proprietary tech.
Right. And another win was in U.S. collections with a big loan subservicing provider. These wins cut across their main verticals, showing the digital and AI solutions are being adopted broadly.
Okay, let's look at those verticals. How is this un-BPO strategy playing out differently across the segments? Healthcare is the biggest slice, right? About a third of revenue.
Yeah, 33.5% of revenue. It grew 6% year-on-year in constant currency. The focus there seems to be heavily on the payer-side insurance companies. They work with 12 of the top 15 U.S. health plans.
And the play there?
It's about streamlining things like claims processing, using tools like their Simpraxis platform for digital intake, reducing errors, speeding things up. That fits right into the technology arbitrage model. And the pipeline, they said, is almost 2.5 times bigger than last year. So strong interest there.
Okay. Next up, banking and financial services, BFS, also about a third of revenue, growing faster at 11% year-on-year.
In BFS, it sounds like the focus is shifting a bit from just traditional back-office stuff towards platform modernization. They're working with regional banks, fintechs.
Helping them upgrade their tech.
Exactly. Taking a more consultative approach, proactively suggesting AI-driven ways to cut costs or improve processes, especially in areas like loan servicing. That's where the new applied AI and Lizard.ai capabilities are likely very relevant, particularly with interest rates still high.
Makes sense. Then the fastest growing segment was communication, media and tech, CMT, 15% growth.
Yeah, CMT's at 15% constant currency growth, now about 21.7% of total revenue. A lot of that growth is coming from digital native companies. And interestingly, from supporting the integration of AI into their clients' own products.
Oh, so?
Think about tasks like creating prompts for generative AI, curating training data, monitoring AI models for bias or drift. High skill work. They mentioned doing this for 4 of the top 5 big consumer tech companies. That's pure skill-based work, totally different from old-school labor arbitrage.
Right, higher value stuff. Okay, the last segment, diverse industries, was flat. Sounds like that reflects the UK market softness.
Seems so, yeah. Utilities and retail in the UK were mentioned as sluggish. Which brings us to the geographic picture. North America is still the main engine, growing 16% year on year. But Europe and the UK are more muted. How's FSL handling that?
Yeah, the UK is usually a strong market for them.
Right. The sources mention slower economic growth there, plus rising labor costs partly due to new regulations. This is actually pushing UK clients to speed up offshoring or nearshoring plans.
So FSL is adapting.
They seem to be quite proactive. They've set up operations in Dubai, specifically mentioned to capture Middle East growth, and they've successfully ramped up their delivery from South Africa.
South Africa is becoming a bigger BPO hub.
It is. And they explicitly linked leveraging South Africa to winning expanded work with a major communications and media client. So they're actively diversifying their delivery footprint to follow the shifting cost and opportunity map, not just waiting for Europe to bounce back.
Smart move. Okay, shifting gears internally now. The board made a couple of key announcements this quarter. First, a big internal merger.
Yes, an internal consolidation. They're merging two wholly owned subsidiaries, Firstsource Process Management Services and Akuna India Services, directly into the parent company, FSL.
Why do that?
The rationale given is pretty straightforward. Simplify the group structure, cut down on duplicated admin functions and costs, and reduce the regulatory burden of managing multiple entities.
Makes sense. Anything notable about those subsidiaries?
Akuna is interesting. It specifically focuses on software design, development, and AI solutions, particularly for healthcare. Folding that directly into FSL reinforces that AI-first strategy we've been talking about. It brings those core skills right into the main structure.
Integrates the AI talent.
Yeah.
Okay. And the second internal shift was a key hire.
Right. A significant appointment.
Yeah.
Ms. Jagriti Bhattacharya is joining as Executive Vice President and General Counsel. She's got over 20 years of experience, including big names like Pine Labs, Citibank, ICICI Bank. Seems like a strong legal hire.
And on the broader people front, headcount.
Headcount went up. Total employees reached almost 36,000. Critically, the net addition in Q2, about 1,500 people, was the highest net add in the last 6 quarters.
Signaling preparation for growth.
That's how they framed it, yeah. Positioning for accelerated growth in the second half of the fiscal year. And attrition continues to trend down, which is good news. It fell further to 28.0%. That's a big improvement, about 12 percentage points better than 2 years ago.
Okay. Better retention, hiring up. So with all this change, the strategy, the AI, the internal moves, what's the outlook for the rest of the year? What are they telling the market?
The outlook seems steady, confident, maybe even a little conservative given the momentum, actually. They reiterated their full-year FY26 revenue guidance, still predicting 13% to 15% growth in constant currency.
Okay, holding steady on growth guidance.
Yes. And they were careful to note that this guidance doesn't include any potential revenue from that acquisition they're trying to make, Past Due Credit Solutions in the UK. That deal is still waiting for regulatory approval from the FCA.
Right, so potential upside there if it closes. What about margins? Still aiming for expansion?
They are. They reiterated the FY26 EBIT margin guidance range of 11.25% to 12.0%. And since they already hit 11.4% in the first half, they indicated they're comfortable trending towards the higher end of that range. So still on track for that 50 to 75 basis point improvement year-on-year goal.
Consistent message on margins. Was there anything else financially noteworthy?
There was one item flagged as an exceptional gain, but it included an impairment charge. Net-net, it was a small gain, but the impairment itself, about $224.5 million, related to an older acquisition, a UK retail asset they bought previously.
Ah, write down on an old deal.
Essentially, yeah. Due to not hitting the original revenue forecasts for that specific acquired business, it was offset by a gain on contingent consideration, but it's just a small reminder that not every M&A deal works out perfectly to plan.
Understood. Okay, so wrapping this up, it feels like the big story here is that fundamental shift in the growth model, moving away from just scaling a headcount.
Definitely. It's growth driven by strategy, by AI-led transformation. FSL is quite explicitly trying to disrupt its own traditional business model, which is fascinating to watch.
And you mentioned earlier the success of this un-BPO strategy changes how we even measure success in this industry, right?
Absolutely. Traditionally, it was pretty linear. Add people, get more revenue. But that link between headcount and output should start to break down if this works. FSL isn't just selling man-hours anymore. They're selling results delivered by a combination of technology and specialized human skill.
So if you, our listener, are tracking FSL or maybe trying to understand where the whole BPO sector might be heading, What should you really be watching? What are the key indicators beyond just revenue growth?
That's the crucial question. You need to look beyond the headline numbers because they can still be influenced by older, traditional contracts. I think there are two key metrics you should really track going forward, things that will signal if this un-BPO approach is truly taking hold. First, watch the percentage of their commercial contracts that are nonlinear, meaning contracts priced based on outcomes or value delivered, not just time and materials. That percentage should be increasing.
Okay, nonlinear contracts. What's the second one?
Second, track revenue per headcount. If this technology arbitrage model really works, if AI and specialized skills are driving efficiency, then this number should accelerate significantly. You should see far greater revenue output for each employee compared to the old model.
Right, getting more leverage from each person through technology.
Exactly. If FSL pulls this off, if they really embed AI at the core and shift to outcome-based models, they won't just be competing with other BPOs. They'll start competing more directly with software companies, with system integrators, maybe even management consultants on certain process redesign projects.
A fundamental shift in their competitive landscape.
Potentially, yes. And that strategic shift, watching how those nonlinear contracts and revenue per headcount metrics evolve, that's the truly interesting thing for you to mull over and track in the coming quarters.